Did I send you an Einstein hat, Charlie?
No. I have some other hats,
I
but
think I
I'll
sent some to Bob.
Yeah, I got a hat. I think it was an orange
Promised
one.
Bob and Maris a hat. I think Ben has some too.
I didn't get a hat yet.
I'll, I'll wear this hat that Ben sent me. Make volatility great again.
That's perfect.
Um,
Perfect. We might.
yeah,
It looks like we might start seeing some of that, Charlie. What do you
I
think?
think we are. I think we are. I've tried once or twice since last fall to get bearish, but I still remain bearish.
Yeah, I'm with you. I've tried a few times myself to no avail.
Well, I will say I had some good luck shorting silver in the last 3 days.
Yeah, that's been a trade. Whoa, what a move! Crazy.
Of course,
All right,
like any
let's retweet this. There it is. Let people know we're here. Got a little bounce in oil, Bob.
Yeah, a little bit, more than a little bit here. We're up in the mid 60s on headlines again. Iran
Yeah,
is Trump going to send missiles into Iran, or what's going to happen there?
something looks like it's percolating. Somebody knows something.
Well, we're moving a bunch of
and
flotilla over there.
Chevron.
We got ships.
Chevron had good numbers too, right? I mean, that's
Yep,
what you'll talk.
Chevron, very good numbers. And remember, my top three picks going into the year, we said were Chevron, Expand Energy, and C&Q. So I was glad to see that they reported a good quarter. I'll touch on that in the call, but yeah, I was very pleased to see a strong quarter there, and they raised the dividend. So
Yeah,
Isn't
that
one of the
looked very good.
read-throughs to the isn't one of the read-throughs to the? I'll ask you this later.
no, ask me now, so I know what you're going to ask me.
Read-throughs to the refiners.
Yeah, the refiners were strong, and that's why I was looking at Valero this morning. Exxon's refining numbers are strong too, but Valero's not really reacting. Valero's down this morning, so I'm not sure
I know
why.
that's what I was confused by because I thought that would have been a positive read-through.
Yeah,
And
I mean the refining numbers are backward looking, and with oil up now, forward looking, it may be the fact that the input costs all of a sudden have jumped up for the refiners that may be a bit of a headwind now going forward.
okay, all right.
All right, you guys ready? Let's get this show on the road.
Mhm.
Welcome to Wall Street Beats, everybody. I'm Steve Lamar. Today is last trading day of January 2026, January 30th. I am joined today by our bank and financials pro, Charlie Peabody, and our oil and gas pro, Robert Morris. And we're going to talk stocks. It looks like we got a new Fed chair this morning, Mr. Peabody. Is he going to cut fast enough for Trump?
So I think people anticipate. I was trying to think through, the market reaction this morning to Warsh's nomination. And if you look at Rocket Mortgage, UWMC, UWM Holdings, Penny Mac, they're all
They're all getting
tanking.
spanked. Yep.
Yeah. And I mean, lower rates aren't necessarily good for some of these guys, but it's the long end that I think is bothering these guys because the long end is selling off, but not dramatically. So I'm trying to figure out what's going on here. And, this may be way off base, but I was thinking Warsh has been adamant about reducing the Fed's footprint in the marketplace. And so is Stephen Mirren. Steve Mirren gave a very important speech about a month or two ago about reducing the Fed's footprint in the marketplace. And if they're both on board with that philosophy, there are two outcomes from that. One is there's no Fed put anymore. That's concerning. And secondly, does that take away yield curve control? And
Yeah.
if it does take away yield curve control, then I can understand why the long end is selling off. Because normally I would have thought, all right, if we have a hawkish, Warsh, that pushes us closer to recession, and therefore the long end would rally. But if they're going to try and run this economy hot, but don't want yield curve control, and these things are all still subject to changes. But I was just trying to think through the different decision trees that an investor has to face. If they're shrinking if they want the Fed's balance, footprint to shrink, then that would imply no yield curve control. Anyway, there are a lot of things that have still yet.
Trump's mandate's pretty clear: run this thing hot, and if he's not playing ball, he's not going to last long, right?
Yeah, that is true. And I was talking to somebody this morning saying, that they think he's being put up to fail. I'm not sure I agree with that, but there's obviously that sort of thought out there.
If you thought the drama between Powell and Trump was good, wait till you see this. Is that what you're saying?
Right. Listen, there are a lot of issues still to be resolved on this Fed nomination and its implications, but no doubt that the initial reaction is for the long end to sell off, and that's hurting, a lot of the mortgage-related stocks.
Yeah.
But the one stock that I did, if you have give me another 2 minutes, that I did want to highlight is Flagstar, since I had highlighted that a week ago and previously on it several times. Jen, I don't know if you can put up the very first slide. You didn't change your mind? No. In fact, the quarter was everything you'd want to have seen. Now, Jen, can you put up the first slide on Flagstar? So these are the metrics that were just reported for Flagstar. And keep in mind, the whole thesis here is this is the first quarter that I was expecting Flagstar to return to profitability after 2 years of losses. And that is a very key inflection point. Now, the story going forward is, can you turn one quarter of profitability into a full year of profitability? And that's what still has yet to be proven. I think they're on track to do that, but that's the hurdles that they face. So let's look at some of the metrics that they reported. So the top line, there was both a beat on the top line and bottom line at Flagstar. They reported 5 cents of earnings. FactSet had consensus expectations of a penny, and I talked last week, break even. So it was a nice beat there on the bottom line. The 5 cents is actually 6 cents if you take out some unusual items. Then, importantly, what we needed to see is net interest income or top line revenue starting to grow again. And that's happening quarter over quarter. And there was a beat there as well. There are some lumpy items. In any turnaround, there's always going to be lumpy items. And so you have to be a little cautious about extrapolating these numbers. But it was a beat on net interest income. It was a beat on non-interest income. Loan loss provisions came in below expected. Operating expenses were a little bit higher, but there were, again, some unusual items on operating expenses. And if you take those out, the operating expenses were in line with expectations. So I feel really good about the underlying metrics. Now, importantly, the non-performing loans, I don't know if you can see that, about 2/3 of the way down this column, came in at 2.98 billion. That $3 billion is a decline of 8% quarter over quarter, so that's good. Criticized assets, which is the bigger bucket of potential new problem assets, dropped by 2% quarter over quarter. Going forward, they have out of that $3 billion of non-accrual assets, they have another $425 million loan that's in bankruptcy. The bankruptcy process was just approved, and that loan will be sold at par here in the first quarter, so no loss on that. So you're going to have another, almost $500 million drop in that from that $3 billion number, and the company expects, over the course of this year, another $1 billion drop, including that $400 plus million loan. So everything in terms of the metrics are moving in the direction that you want. Now you get down to the bottom and you look at book value or tangible book value, and as I talked about, it's around $18 plus or minus. And I think now you can start thinking of that book value as being real. And so the question is, can you get to a return type of number that justifies you trading at tangible book value? And if we can go to the next set of slides, Jen, here are some of the forecasts. So I just gave you what they reported in the fourth quarter. here are some of the forecasts. I don't know if you can read these numbers, but let's look at the right-hand side of the page. The top is, forecasted earnings per share. So in 2026, they're going to have their first full year of profitability. So you're potentially taking one quarter in the fourth quarter of profitability to a full year of profitability. And if you look out towards 27, you're looking about, just under $2, a share of earnings, which is what I had talked about last week. So that is going to be a function of improving your efficiency ratio. So your expenses will be constantly declining, whereas your revenues will be growing. So you're generating positive operating leverage. And that revenue increase is going to come from improved margins and improved loan growth. Because you've been running down all of these commercial real estate credits, so it's been hard to grow your balance sheet and grow loans. But and then finally, your credit quality is improving, and you're able to run down your credit problems at your carrying value. So you're not deteriorating book value. So I think you can get to, at the very bottom middle, you can get to a 10 or 11% ROTCE. They're talking about 11, 12. Sometime by 27.
Charlie,
so
are these yours? Are these your numbers, or are these are these theirs?
These are their numbers.
Got it. Okay.
And I think they're reasonable. I mean, I sort of penciled in some assumptions, and I think they're all reasonable. So you had, for example, you had an efficiency ratio of 84%. That means expenses are eating up 84% of your revenues. In the fourth quarter. And there is a very clear path to expenses declining, so I feel good about the expense side. So, in the fourth quarter, you were at a $2 billion expense run rate. And I think there's a very clear path to declining that, so I like the idea that expenses can come down. The revenue side is always harder to forecast, but there's really, the margin improvement is, I think, very real. They had a margin of 214 this quarter. Banks of their nature, have margins closer to 3%. The company talked about every quarter going forward is going to show margin improvement. So that helps your top line revenues, particularly if you can start growing C&I loans, which they showed good growth in. So I think it's a real story. And I think this, it's hard, for the stock to move up in a market like today, which is very, difficult market. But I think the stock can move up by the end of this year towards 18, which has been sort of my target, and maybe, $21 by early next year, the first half of next year. So I like Flagstar.
Yeah, those that earnings bump from 26 to 27 looks great. I mean,
the simple thing is it's a better efficiency ratio and improved margins. Those are the simple metrics, and obviously the ability to work down your problem assets at carrying value.
So would you, with new money, would you buy it here?
I would actually, because I would have thought the stock would have been up 2 or 3% today, but because of the backdrop, it obviously is flat.
Yeah. Okay. All right. So we're liking what we're seeing out of Flagstar. FLG is the ticker. Do I have that right? Okay.
Correct.
All right. Good stuff. All right, Bob. Let's hand the baton over to you. Is this new Fed chair have any effect on your names, or you're more interested in what's going on in Iran right now?
We're more interested in headlines still and some of the earnings as those sort of kicked off. We had the service companies, some of the bigger service companies last week, and then today we had Exxon and Chevron. And while Charlie's very happy with Flagstaff, we're very happy with Chevron here this morning. We came into the year
amazing numbers.
Noting that our top 3 picks and continue to be for the year: Chevron, Expand Energy, and Canadian Natural Resources, or CNQ. So, to begin with, oil prices are up, which is obviously a bit of a tailwind for all the names in the energy sector. And the energy sector is the best performing sector year to date. Oil prices are up here around $65 a barrel, a little bit above $65 a barrel. And again, has been the case all year. It's being driven by headlines, and that headline is the increased concern that the U.S. may attack Iran or do some sort of intervention there as they continue to move warships into that region, and as the rhetoric continues to go back and forth, even though Trump says that Iran wants a nuclear deal, we're not sure that that means that they really do,
Right.
and sort of how all this plays out. So the bottom line is, while on the other side they're trying to negotiate a peace agreement between Russia and Ukraine, and those efforts have stepped up a little bit here, wherein if we did get a peace deal there between those two countries, that could lift some of the sanctions on Russia, put more oil into the market. At the same time, as you know, they're trying to ramp up or increase output of oil from Venezuela and ship diluent down there to mix with that heavy oil to be able to ship that out and move it into the market. And in the meantime, it's interesting because Iran, they're exporting about 2 million barrels a day, which is above what they should be per the sanctions. And I think some of the speculation is that to date, the Trump administration has sort of turned a blind eye because they want to see oil prices down. And so they've not been as aggressive in enforcing those sanctions, with Iran production ramping up here and exports ramping up above what they would otherwise be if those sanctions were strictly enforced. Most of that oil is going to China, but nonetheless, that goes into the global market, and that's been a little bit of a weight on oil prices to date from a fundamental standpoint. But we'll see where we go from here. Clearly, if there continue to be tensions, if that risk of some sort of attack by the U.S. on Iran continues to be in the market, then oil prices probably hang in here in the mid 60s. If tomorrow there's some resolution or there's some tweet or headline out of the Trump administration that all's good and they got an agreement and things are fine going forward, we're not going to shoot missiles into Iran, that oil price could quickly come back toward $60 a barrel. So it's difficult to predict. We'll just keep an eye on it here. I can tell you that $65 oil for the rest of the year would be positive for the valuations for the oil companies. So when we look at Chevron here this morning, they had production was a slight beat versus consensus. A big part of the bottom line beat on the earnings versus consensus was the continued reduction in costs, which all companies have been doing, but they had a nice reduction in costs. The refining segment was very strong, and they increased the dividend by 4%. And the other part of it is in Venezuela. Remember, they're the one U.S. company that currently operates in Venezuela, albeit their production in Venezuela is about 250,000 barrels a day. But they did say that they could increase that by 50% in 18 to 24 months. Ways out, and it's really not going to matter near term on the oil market, but they are talking about the ability to begin to ramp up production and being active in Venezuela, where other companies like Exxon are standing back and saying, well, we need a democracy or more stable regime or some sort of firm agreement before we invest money there. Bottom line, my price target starting out the year on Chevron was $180 per share. I'm going to revisit that or see what happens with that post their earnings call, which starts at 11 o'clock this morning. See what they say, go through, update my models. But, we'll see if that moves up or not, just given the results and what they say on the call. But I still like Chevron. It's one of our top picks in the energy sector. Exxon also.
If you don't own it, Bob, would you buy some here?
I would. Yes. You're getting a nice dividend here. You've got the tailwind of the strong earnings and what happens in Venezuela going forward, strong refining margins. So I would. I wouldn't want to.
Staple. Yep.
I don't want to taste it, but I don't want to be left. I don't want to be left behind. At the same time, Exxon reported this morning, and similar to Chevron, production was maybe a slight beat. The thing the market was disappointed with for them is the chemicals division was weak. They had actually a loss in the chemicals division, which is why you see that one underperforming Chevron today. We still own Exxon. We have a bigger position. Exxon, we still own Exxon. We have a bigger position in Chevron, but we do own Exxon and would stick with that. I'm not changing my view or selling Exxon on the results here this morning. Otherwise, on the natural gas side, Mother Nature continues to deliver for the natural gas bulls here, and then now we've got the cyclone bomb. Thankfully, it's not going to hit New Jersey or the northeast part of the U.S. It doesn't look like it's going to concentrate on the Carolinas, but nonetheless, it's delivering very cold weather. And looking at the forecast, it's going to be extremely cold here for the next 2 weeks. So that's providing a continued lift to natural gas prices and keeping them strong here. And obviously providing a lift here this morning to names such as Expand Energy and EQT, which we own. So I mean, that's a positive on that side. So that's sort of the bottom line here. We're not certainly not selling anything, sticking with our top picks. Again, as you pointed out, Steve, if you don't own Chevron, would I buy it here? Yeah, I do want to own that name long term. That's one of it's our favorite name among the integrateds and overall one of our top three picks here.
And less so for Exxon?
Less so for Exxon, and that's been the case. I like Exxon, but I like Chevron more. I'm market weight Exxon, but I'm overweight in our position in Chevron. The other name
And
I
then
mentioned, I want to mention one
gas
other name
names,
too,
go ahead.
is Valero.
Go ahead.
Valero reported yesterday, and interestingly, the stock's off a little bit here, not because they really missed on earnings. Renewables was a little weak compared to what people were expecting, but they increased the dividend by 6%. People are a little concerned about refining margins going forward, just given input costs, i.e., the oil prices up here. But it's a name I still like. So remember, we were building a position in Valero, still not to a market weight or full position I want to be at. So on this pullback, we'd originally been building our position below 170. So I'll watch it here to see if we get any further weakness, and maybe I'll buy a little bit here today to continue to build that position. But despite some profit taking following the earnings yesterday, I still like the name here.
Okay. On the gas names, I mean, as the weather subsides here, would you start to see these stocks kind of trickle off?
I
As
would,
a result,
and maybe
really seasonal? Is there really a lot of seasonality to these names?
there is some seasonality, and you may recall, was it last week or the week before? Maybe I was a little bit early. I wrote some covered calls on half my position in Expand Energy and EQT out in April and May, just with the view that in that shoulder period into the spring, you would see some seasonal weakness in the gas price come back down to more normal levels. Now, again, I was in doing that, I was a little bit blindsided by Mother Nature, and that weather came back through. And so I'm looking to Expand Energy. It's above, the strike price. I wrote those then out of the money calls on half my position. And EQT is only slightly above the strike price on where I wrote those out in April and May. So honestly, I'm not overly concerned about that right now, just because, as you pointed out, Steve, there should be some weakness relative to where gas prices are today once we go in the shoulder period. The shoulder period being April, May, when there's really no heating or cooling load demand. And as we begin the transition from withdrawing natural gas from underground storage to refilling it during the summer. The thing that would fly in the face of that view is if we continue to get this extreme cold weather and we get to spring and storage levels are at a low enough level that people start to be concerned about being able to refill then storage going into next winter, which in that scenario could keep natural gas prices strong into that shoulder period. So we still have to keep an eye on what the weather's doing and what that does to natural gas storage levels as we approach that spring shoulder period. So, did I jump? I wrote those out of the money, then covered calls on about half my position and Expand in EQT. Was I being too cute on that? If Mother Nature could prove me wrong, we'll see. That would be the one thing that and she's trying to do that right now. But that's
and you could. When do they expire? Are they March expiry? Are they March expiry?
No, April and May.
Okay.
Because only one of them traded in April and one of them traded in May, and so that's how I wrote those.
Got it. So you got a lot of time in there, and you can roll them if you need to, etc.
Yeah, it'd be easy to roll them from there. So I'm not really overly concerned about it now. Should I have waited a little bit here? Sure, but I didn't know this weather was going to be as extreme as it has been since then.
Yep. Okay.
Hey, Steve, I wanted to make another observation, playing off of what Bob said about Exxon's chemicals operation. Because if there is success in running this economy hot, I've been playing that theme through some of these deep cyclicals, and I've mentioned some of them on the prior shows. One being Dow Chemical, and they reported disappointing numbers, and the guide, first quarter was slightly disappointing. You had a one-day sell-off on that news, and the stock is actually up today in a weak tape. Dow is.
Yeah.
So the other thing that I want to point out in terms of,
are you signaling you'd be a buyer here on that dip from yesterday, even here?
I did, yes.
Yeah.
I own Dow. Yeah. I also own LyondellBasell, LYB. I've been
Yeah.
buying these cyclicals because I just like the asymmetric risk reward. They've been flat on their back for a year or so. But another indicator of the run hot economy have been these staffing names I've mentioned as well. Look at Robert Half today, RHI. If you can pull that up on your tickers, RHI.
Yep.
You know, I've talked about how the American Staffing Association index shows demand improving since November. I've talked about the JOLT status showing big job needs of 7 million plus. I've talked about how the National Federation of Independent Businesses (NFIB) has expressed optimism about the need to hire. And then yesterday, Powell in his FOMC press statement said he's less worried about unemployment and is more neutral and sees that as improving. So Robert Half this morning came out with it's up 22%, 23% today. Came out with some very positive looking forward and gave guidance that was above street expectations. I do own RHI, by the way.
So Charlie, how do you square that with AI taking jobs? That just doesn't.
Well,
that doesn't make any
I don't know that AI has yet really taken significant jobs. I suspect over time it will. I mean, there won't be any need for me anymore as a research analyst. I'm serious. I mean, I use AI now for trying to
AI isn't wise, but okay, they can give me the facts, I guess, most of the time.
I mean, there'll still be a need for price interpretation. I guess that's where we can play a role. But,
and forward thinking, and a lot of things AI can't do. But
yeah.
By the way, Charlie, I agree with you on the industrials, the counter cyclical. I also own Dow, Lyondale, in addition to Air Products and Linde. So.
Okay, good. Well, I'm
what's
glad.
Air Products and Linde? What's the ticker for that one, Bob?
APD, and Linde is LIN. I recently bought Linde on the sharp pullback, so that's a new position in the last month.
APD and LIN. Okay, cool. We'll look at those.
I own a host of these things. I'm also looking at some of the packaging companies and lumber companies like Weyerhaeuser or West Fraser. I haven't pulled the trigger on those latter ones, but I think I'm
a new packaging customer with my Stuff bars, buying a lot of boxes and wrappers and shit.
I think February is going to be a very difficult month for this market, and I've been shorting things going into February here, but I thought that back in September, and I thought that back in November, so we'll see.
Well, it's a new year. Everybody's sitting on a lot of gains. It would make sense for some people to start taking some profits around some of this uncertainty. And Bitcoin is definitely signaling risk off here.
Yeah, and as are precious metals.
Yep. All right, guys, let's wrap it up. Thanks for joining us on Wall Street Beats. Have a great Friday. Thank you, Bob. Thank you, Charlie. And we will see you back here next week. Follow us on wallstreetbeats.com. And
Thanks,
make
Steve.
volatility great again.
Yeah. Thanks, Steve. Thanks, Bob.
Bye, guys.
Thanks.